Hello and welcome to MoVeConversations. This is your host Venkat. In this episode, we talk to Mr. Srinath Keshavan. Srinath is Chief Executive of Trade Risk Consulting and a very well-known trade finance consultant. He has been a trainer for Euromoney and World Bank Group for many years. My co-producer Mrigank and I know Srinath for many years now in Singapore. We are grateful for all the encouragement we received from all of you for our new series called MoveConversations, TradeStuff. And in this new series, within the MoveConversations, we talk to international business and trade professionals like Srinath. So welcome to MoveConversation TradeStuff, Srinath.
Thank you, Venkat. Thank you for inviting me.
Our pleasure. So let's begin with how you got started in trade finance and subsequently, consulting and training bankers and other industry professionals in this area.
Well, every shift in my career has been incidental.
Okay.
So it's been a journey of accidents happening right through. So when I got out of, finished my master's degree, I was looking for a job, and back in the late 70s, it was more a case of taking what you can get rather than trying to be picky about what you want to do in your life. So along came a management trainee position with a textile firm in Ahmedabad.
Okay.
So I took that up, and I was placed in the exports department. So that was my incidental entry into international trade. So for roughly 5 years, I was, titles aside, essentially a salesperson. Had nothing to do with finance or trade finance. So I had no clue about it. Although at one level, I did have some aspirations of going the accounting route.
Okay.
But anyway, what happened was that personal circumstances drew me to Singapore, to Hong Kong actually, in the mid 80s. And one thing led to another. And I suddenly found myself applying and interviewing for a position again as a trainee 5 years after I'd started working, but in an international bank. And that was the start of a beautiful relationship with trade finance. So I worked for the Bank of Credit and Commerce in Hong Kong, which by itself was quite a remarkable bank.
Yes,
and my
BCCI International.
Yes, my memories are very positive. I learned a lot.
And there are a lot of lovely people there, right?
Fantastic friends, some of whom I'm still in touch with 30 years later. And I have the greatest respect for many of the people that I worked for. So my experience was altogether extraordinary when I was working in the bank. And considering I was at a junior level, essentially.
Right.
But the experience that I gained was fantastic because I started in, I went through close to, I think, all told about 14 months of traineeship as such, where I had, daily classes 9 to 5, examinations, then on-the-job training before you were finally set free. And I started in trade finance operations. So I got my hands dirty, checking documents and processing documentary collections, issuing letters of credit and all that.
Right.
Great learning. Managed to deal with a lot of volumes and high performance standards. Because that was something that was new to me at that stage in my life. Then I moved on to operational positions within the branch level where I became a little more front office. And finally, I became what you'd call today a relationship manager. But I went beyond managing a portfolio of clients to actually writing credit papers and all that. So great learning. And then the bank blew up. And there I was looking for something else to do. I was fortunate again. An Indonesian group, which happened to be a client of BCCI at that point, approached me. And I found myself in Singapore as financial controller for a startup cotton trading company. That was another incredible journey where I had switched back from the banking side to the corporate side. And while my responsibility was broadly over finance and administration, I was brought in because of my perspectives as a banker, ex-banker. So that took me another 3.5 years. Then for 2 years, I was in a bit of a wilderness in terms of the fact that I had decided to go on my own. And I attempted a few things like trying to arrange trade finance for clients. I realized that's not something I really want to do. And then one of the European banks hired me for a year-long project, which was focused on commodities in India.
Right.
And that really, again, got me going. And that led to another position to GPRMG. But after GPRMG, I got into training and development and learning. And that's a whole wild journey by itself.
So, great inspirational story for people, about resilience, especially, right? So many adversities and you bounced back every time. And then at some point you decided that I'll start on my own, which will be a better way, be an entrepreneur, not only being a consultant.
Well, being an entrepreneur was not really a conscious choice because at the point in time when GPRMG also shut its operations in Singapore,
right,
we were just getting to the fag end of the Asian financial crisis.
True.
The conditions were not ideal, and a lot of companies were collapsing, and it was really not the best time to make myself an attractive candidate for a similar position. And so,
right, absolutely, yeah.
I said, what do I do? And along came an incidental training opportunity from what was then the Trade Development Board.
Right.
And I recall that conversation. Somebody called me from Trade Development Board and said, hey, we want you to talk about letters of credit. And I said, yeah, sure, I can do that in 5 minutes.
I've seen all the good and the bad ones.
So they said, no, we want you to come and speak for the whole day. I said, how am I going to speak about it for the whole day? I can only talk about it for 5 minutes. What more can I say?
And that changed, Srinath?
But I found myself that day, I was supposed to end at 5 p.m. and I was still talking at 6:30. So probably I found my new passion, my new love, new calling.
Absolutely.
And well, the rest is history.
So let's step back a little bit from a conceptual point. For the uninitiated, or people who have just heard about it, explain what is trade finance.
Okay. Let's dial back a bit. When we think about lending to corporates,
right,
businesses, the traditional model has been to first, from a bank's point of view, to satisfy themselves about the financial status of the customer, the purpose for which the loan is granted, when will repayments be made, etc., etc. And revolving around that scrutiny, decision is made by banks, which to a great extent still occurs because that's the corporate banking business to a great extent. And once the funds are disbursed in whatever form or the credit is disbursed in whatever form to the borrower, the corporate doesn't provide a real-time access to where the funds are being deployed or how it's actually working for the company. They probably provide a periodical financial statement to reassure the lender that they're in good financial state and they have the ability to repay, so on and so forth. So lending to corporates in that way, corporate banking in the most general sense, I'm being very, very general here, is really about lending to a business against their financial status represented by their financial statements. And the source of repayment is the borrower themselves. Trade finance is different. In trade finance, we, of course, also, as lenders, scrutinize the financial status. But we also pay a lot of attention to the actual transaction that needs to be funded. And when trade finance is actually disbursed, it tends to be more at a transactional level. That's why trade finance falls under transaction banking in banking institutions. So if you ask me to define trade finance, it's not so much about financing the borrower. It's about financing a trade transaction of the borrower.
Right.
And in that way, trade finance distinguishes itself. But at this point, just to complete what I'm saying, we tend to characterize trade finance as being short-term financing.
Right.
Whereas you've been a trader yourself, so the vast majority of transactions get completed within 180 days.
Correct.
But let's say stretch it to 360 days. Occasionally, the transactions are beyond 360 days, but trade finance, the vast majority is completed definitely within 360 days. So that's short term. We say it is secured financing because the first collateral that we look for as a lender are the underlying goods.
Right.
And so we try to control the document of title, like a bill of lading or whatever.
Right.
And the third is we say, this is very important, that's really distinguishes trade finance from other forms of corporate lending, is it's self-liquidating.
Yes.
So when we say self-liquidating, in the normal sequence of events occurring in a transaction, the transaction repays itself.
Exactly. Right.
So you have, for example, a supplier, you've got a trader, you've got a buyer. And the trader is the one who goes to the bank and gets financing to buy from the supplier and then receive payment from the buyer. At the end of the day, the bank is looking at the trader, but they're looking more also at the buyer at the end of the chain and saying, is that buyer good enough on which we can take a payment risk? So the payments coming from the buyer then feed into the trader's obligation to offset the loans.
They look at the export credit risk of the
exactly
trader.
So in the normal course, the transaction is supposed to repay itself. It's like a working capital cycle that is revolving all the time.
True. Good. That gives a good context setting. Let's come to the sort of more recent times. So what are the, as one would say, winds of change, that are sweeping the global trade finance?
Quite dramatic changes, actually.
Yeah.
In more recent times, and I say go back the last 3 to 5 years, there's been considerable discussion in the trade finance community about automating processes. And so there's a lot of discussion about digitalization, and now digital transformation.
Right.
And banks in Singapore have been at the forefront of it. You hear of some of the local banks that we have leading the charge from the Singapore side. Unfortunately, trade finance has somehow stuck to very archaic processes where typically we rely on documents being put together, those documents physically being signed and typed up or printed on a computer within the office of the trader or the borrower.
And those photocopies in quintuplicates.
Yes, physically being delivered to a bank, and the bank then goes through a checking process and then physically couriers the documents to the other bank on the other side. And so it's been very document centric, very physical in its interactions, and it's never really changed. And all the rule frameworks, like the ICC rules, have sort of revolved around the physical movement of documents to represent trade transactions.
Right.
And it's somehow something that the whole trade finance world has always been very comfortable with. And then, of course, several years ago, the whole digitalization movement started. Some of the banks worked in isolation and worked with a few select customers to run pilots. And the results were quite encouraging. And so over a period of time, the discussion has now engulfed the whole industry. And so any trade finance conference you go to, digitalization and automation is going to be a big part of that conference. So that's one very big significant change. Then the pandemic has accelerated digitalization or discussion on the intentions of financial institutions to really go wholesale into digitalization.
Right.
Simple things like when you're shut down, how do you deliver documents because people are working from home?
Correct.
Who do you deliver documents to? Then once the documents are processed somehow with a skeletal staff, there's no courier service that's available to move the documents from one location to another. So, you suddenly discovered impediments to your normal physical handling of documents.
Right.
Therefore, the digitalization process became far more urgent. And so that's one very big change that is occurring. And going forward, I think that'll be the direction in which trade finance will transform.
Right. I wanted to ask you what's happening on the, because many of these are also related to, regulations and compliance and, so what's happening in those things? Because it's not only the, banks per se, right? And, they're the governments, the banking, the overarching banking community, not just the individual banks and so on and so forth. So has there been significant changes in global regulation, compliance issues, and so on? And has that landscape also changed, with the trends?
That's actually an older discussion, but yes, very significant change. Back in there were a series of crises, initially country specific, then they became regional specific, going back to the 60s and 70s. In my opinion, one of the most significant, shall we say, events was the Latin American crisis, where many of the European and North American banks had substantial exposure that they'd built up.
Right.
And when things started going bad in Latin America, all at the same time, the balance sheets of many of the world's largest banks, not counting the Japanese were actually at that point leading the rankings of the biggest banks in the world. But the European and the North American banks suffered huge losses. And that really caught the attention of the regulators, where they said, hey, these banks have been building up their franchises, they've been expanding, they've been internationalizing, they've been aggressively giving out, taking exposures on clients all over the world. But when things go bad, how do they manage their balance sheets? So the concept of capital adequacy was brought into the discourse. The narrative changed after that. So once capital adequacy came in, it changed the way banks managed their businesses. So if you can just imagine in your head a balance sheet of a bank. On the asset side, you have, say, loans. On the liability side, you've got deposits and interbank borrowing.
Right.
So as long as you could balance those two, life goes on. But suddenly when your loans start going bad and there's a diminution in the value of your loans, what do? Do you go back to the depositors and say, hey guys, I made a loan loss, I'm not going to repay your deposits before? You can't do that. You'll be run out of town. So that's when the focus shifted and say, oh my God, what we need to do is now look at how much capital we have on the liability side, because the capital has to absorb those losses that we're incurring on the loan side, on the asset side. And therefore, these regulators realized that the banks were operating on very thin capital bases. And that was really making the whole banking industry very dangerous.
Right.
And that became even more evident later on with the many crises that we came to. So that has caused dramatic change, and waves of regulation have come in. Trade finance, I believe as a trade finance person, that trade finance has been treated rather unfairly as a banking business when it came to global banking regulation. Because on the one hand, ICC and many of the stalwarts financial stewards in trade finance have put forward the case that trade finance is actually a very safe business for the bank. It's very transactional, it's very visible, there's real-time visibility. It can be controlled. There are many ways in which it can be controlled. We won't get into those details, but it's a far safer business than just giving a loan to a corporate and waiting for monies to come back to you.
Exactly.
And yet, there has been some response from the regulators, from the global forums, but it's still not ideal to a point where the uniqueness of trade finance has been recognized. So global regulation has in a way stifled some of the growth of trade finance. It has led to banks discharging the smaller clients and focusing more on their bigger customers who have very substantial relationships and are of a high order. That's one side. And then the other side, which happened in the year 2000 onwards, has been compliance. The focus on compliance has really taken off because, again, many of the world's largest banks have been severely penalized for breaches in financial crime compliance. So that has started a whole wave of awareness about how compliance needs to be done. And in trade, it's particularly vulnerable to misuse by financial criminals. So when we talk about money laundering, we talk about sanction breaches and all that. So these are things that I talk about in my trainings as well. So yeah, that's another major development that has changed how banks interact with their clients and how they look at transactions, so on and so forth.
So these would have, impacted the lender's profitability and so on, right? Already, the thin margins, and then they wanted them to be have more cushion to absorb the kind of risks that they were taking, and so on and so forth, right? So what happened in this context?
Well, trade finance has generally been very, like I said, paper intensive and manpower intensive too.
Correct.
It's a natural corollary.
Right.
So
more verification, more checks,
checks, etc. Now with the advent of technology, many of these processes are being automated.
Okay.
Which is in a way a good thing. So the nature of skill sets that now trade finance people need to have is also gradually changing.
Mm-hmm.
The world that we'll be living in as trade financiers will be very different from what we might have done, say, even 10 years ago.
Mm-hmm.
So yes, banks have re-examined their portfolios. And one of the things they look at is risk-adjusted rates of return.
Mm-hmm.
Purely on risk-adjusted basis, trade finance should do well. But when you look at the overheads that banks have had to incur in order to maintain a significant trade finance franchise, it has not turned out to be as profitable.
Right.
And that has therefore led for them to either prune their clients or get out of trade finance all the same.
Yeah.
And you saw that very dramatic shift happening just recently, in fact, 2020, when oil prices collapsed. We had a wave of collapses of oil trading companies in Singapore.
Yeah.
We can talk about that separately, but in terms of impact of banks, some of the major commodity financiers have shrunk their operations or completely exited that business. So this is going to have a massive effect on borrowers going forward, particularly in the more vulnerable locations.
Right.
So yeah, again, a lot of things happening, and many of this is unpredictable.
Right. So you just mentioned about the collapse of the oil trading companies, and would you want to talk a few anecdotes and how it impacted both people in the industry on one side, who probably were in better positions, as well as some of the banks? What is it that whatever you can share in these areas? I guess by now most of the things have become public information, so I guess
I'll only speak about stuff that's public anyway. One of the big, shall we say, collapses occurred a few years ago on account of a type of warehousing finance that was done in China, in Qingdao, in particular, where fake warehouse receipts were the basis of transactions. That led to huge losses for the banks, estimated to be, for the foreign banks alone, $1 billion. And for the local Chinese banks, perhaps significantly more. In the case of the oil collapses, if you read the reports put out by the judicial managers till now, you hear about things like cargoes that were pledged actually already had been sold off or disposed of, unauthorized extractions from tanks, fraudulent documents being presented. So, when you listen to these stories, as far as recent as last year, one is led to believe that why hasn't the banking sector learned its lessons? When Qingdao happened, when the oil collapses happened, I'm willing to go on record and say I really didn't have sympathy for the banks, because the way in which they've been cheated, the way they've been fooled, the borrowers have used age-old tricks.
Right.
Age-old
Exactly.
tricks. This is ancient history.
Correct.
And banks keep falling for it. And so, yes, now they're reacting to it in terms of, for example, setting up a trade finance registry in order to make sure that there's no double financing, triple financing of the same cargo, that invoices, whenever receivable finance is being done, the invoices are checked to be genuine. These are fundamental checks, and unfortunately, many of the banks have reacted too late. And this, despite the fact that they have sophisticated information systems, they have the ability to keep checking on clients. But I sense some degree of casualness in certain parts of the bank. So it's certain lenders. So that has probably led to some of these very tragic situations. And it's really tragic because it's not just affecting the bank, but it affects the borrowing community as well. The business community.
Exactly. The good borrowers end up getting more pressured, more compliances, more checks, right?
That is inevitable. That is inevitable, and that is good in the long run. It is good because,
but they also get caught in more bureaucratic things
like,
whereas the bad guys get away.
Get away with it. Yeah, I mean, like the more higher pricing for those who continue to get finance. At the top tier, of course, life hasn't changed so much for them. At the top tier, they still get oodles of credit, and pricing is still a issue that they have to discuss with their banks. But it's the ones below the top tier that are suffering. And then you look at the bottom half, and those guys have virtually been abandoned.
Right. It has a close parallel in consumer banking level of average retail customer getting pressured frequently for with KYC compliances and refilling the same document, resubmitting it, and then this and then and these guys are never going to probably do money laundering, but the guys who do those kinds of scandals, they get away, right? And it's the average customer with his neighborhood bank.
I wouldn't equate what's happening in other parts of the bank with what's happening in trade finance, because some of the processes that you just alluded to are necessary because the regulators are putting a lot of pressure on the banks to institute processes where they have to do this, what we refer to as customer due diligence. So today, opening a bank account is not as simple and straightforward as it used to be even 5 years ago. Banks are obliged to do the checks even for a walk-in customer, and in fact, if you walk in without references, it's different if you're in Singapore, you have an NRIC and your credentials can be checked, but in many parts of the world, there's no such system. So it becomes challenging for banks to even decide who to accept as a customer or not. So that is something that the banks have to do. And like I said, it appears very intrusive, it appears very cumbersome, time consuming. But and banks are working hard to find better ways to do it, but it's something that we cannot avoid. But trade is in a challenge of its own, and I believe trade should, the trade finance community should, and why should I should? They are actually spending a lot of time trying to figure out how to avoid the type of tragic situations that we've come across. I just hope it doesn't happen that frequently as it unfortunately has in the last 10 years.
Right. But and like you said, these things have been happening frequently, even when you go back all the way to the Latin American crisis, and then subsequent iterations, the form, shape and geography may change, but these things are getting repeated. And
yeah, I mean, I was reading Bloomberg just 2 days ago.
Okay.
And there was a case of a very large, globally recognized trading company. Okay, so this is a heavyweight.
Mm-hmm.
They had bought a copper cargo from Turkey, and they were shipping it to China.
Okay.
According to their sourcing, they actually did have container loads of copper ingots.
Okay.
It was checked and container was sealed.
Mm-hmm.
Between the time the container was sealed and the time that the containers were opened in China,
Mm-hmm.
something has happened, resulting in on the Chinese side, they're finding that they actually don't have copper ingots, but they've got some stone,
Mm-hmm.
which is painted to look like copper.
Okay.
Now, how rudimentary can that be?
Exactly, right. This was
how
something taught to us
crude
in
can it
business
be?
school, right?
Yeah,
When I
so
went to business school, they taught me, things like this, right? They have to be allowed to, and there are procedures, right? You have third party like SGS or Bureau Veritas and others who do
well,
these
again,
inspections, and
they've
then
done the
now,
no. Those guys have some inspector has done the inspection,
yeah,
and the container has been sealed. But what has happened is that the container has been broken into.
right.
Sometime between the time the goods were received for shipment and the goods actually arrived.
Right.
And somebody just stolen the goods and replaced it with stuff that is garbage.
Wait a minute, Srinath, but there is already a, Singapore-based company, for example, which has a
Yeah,
GPS tracking device
exactly.
on all high-value cargo. Most people put that thing, and at every minute you know where it is, and if it is tampered with, all of that. So was that tampered, or they did not even put such a GPS tracking security lock that which is very well known?
I don't have the detail as to whether
Fair
they
enough.
had adopted that technology, but clearly something has happened to allow for the switch of cargoes.
Right.
And, the tragedy has occurred. But when you analyze it, me as a bystander, I just read it in the paper. I just shake my head and I said,
Exactly.
how can
Right?
this happen in this day and age?
Exactly.
And the technology you refer to, I think it's a Singapore company that has created this technology where you can remotely control
Yes.
the opening and closing of containers, or at least the opening of containers. I don't know the full details of that technology, but I've heard about it.
Yeah, not only it is for containers and even other cargo.
Yeah,
It's a device, security device, and it's put on the container or high value electronic cargo and so on and so forth. It is there all along, and any tampering and any given time you can know the location of that particular container or that carton or whatever that thing is. And
probably this event will trigger a greater, shall we say, interest in adopting these technologies. Clearly, it's not being adopted worldwide.
Yep.
But it is something that's become necessary, and right time, right place, I guess.
Absolutely. Thank you for joining us in yet another episode of Move Conversations. Hope you enjoyed this episode. Please subscribe to the Move Conversations YouTube channel and press the bell icon to get notifications of new episodes. Thank you very much. Till I see you in the next episode. Thank you very much. Have a great day.